Hi everybody, this is Thomas Wynn of Wynn Capital Management, and I'm going to offer my thoughts on the current government shutdown. First of all, there have been 17 of these, and after all was said and done, the market, about a month after the shutdown, rose 0.7, a fraction of 1%, 1 month after. What can we expect during the shutdown? Probably increased volatility. That hasn't really happened yet, but it could happen, and no one knows what the future holds for what goes on in Washington. And should we take any action, I'd suggest that everybody review the important parts of their portfolio: your asset allocation, your diversification, your expenses, and your taxes. Think about the things we can control. Try not to worry about the things that are out of our control, and attempt as best we can to ignore the media drama and focus on long-term drivers of success. This next slide is a quick review of all 17 previous shutdowns, and it's organized by the date, how long the shutdown lasted, and the performance before, during, and after the shutdown. You're welcome to pause this and take a look at this if you're interested. I've circled a couple things. There was once a 4% decline back in '79 during one of the shutdowns, but that was the biggest decline during. 1 month after, there was a total decline of 6.7%, again back in the 70s. Then in the 80s, there was a jump of 11%. I'd like everybody to focus on the average or the median down here. They're very short, typically. 1 week before, the market has gone up before the shutdowns. During the shutdowns, it's almost made no movement at all. 1 day after, a tiny movement down. 1 week after, a fraction down, and a month after, the market's usually up, a fraction of 1%. That's basically what has happened. No one knows what's going to happen in the future. Past performance is not indicative of future performance, and past shutdowns don't predict future shutdowns. Obviously, anything can happen. But the bottom line here is organized that Wynn Capital Management clients are appropriately invested relative to their circumstances. And we look at everyone's age, your financial condition, your job security, and risk tolerance. And if you haven't done that recently, you should take a look at that. Make sure that you can endure whatever the market throws your way, that you can endure the risk. Also, we're globally diversified. Over 11,000 securities in our typical portfolio. We own a little bit of just about everything that's out there in the global assets. Our costs, which you can control, are a fraction of the average investors. Remember that your total costs, your all-in costs, are the advisor fee, the expense ratio of your investments, the trading fees that are generated, and the implication for taxes. That's your all-in cost, and you should know what that is and try to reduce that whenever you can. Here at Wynn Capital, we also actively manage risk using options hedging, and we have a small hedge on right now at the moment for appropriate clients. And obviously, we're watching the situation closely, and if opportunities arise, we'll make every effort to exploit them to our benefit. For example, if the interest rates were to spike suddenly, we'd very quickly adjust our bond durations to lock in lower bond prices and higher yields. So there's opportunity if something strange happens, and that's how we like to look at it, as opportunities rather than as risk. So I hope you find this material helpful. If you have any questions or comments or would like to discuss any of these issues in greater detail, you're welcome to call me anytime at the number listed below. Thanks a lot. Bye-bye.